Hello everyone and happy Monday. Welcome to this analysis. I'm going to drop it on the S&P 500 E-mini futures chart. Currently got it on the daily display at the moment. We're going to go for a full rundown here and we're just going to talk about near moves and talk about really the way we wanted to trade it. I did do a video on this last time, but it's just to solidify in your brains a lot about how you can manage the market at different scenarios, because you really need to know more or less how you're going to drop your size or adjust your size to fit what's going on at the time. So really the chunk of price action that I'm going to be referring to today comes at the start of Friday, the 11th of November. Of course, we're now on the 12th of December, so that's a month on. So this bubble here I've drawn represents a month of price action. Now, you will notice it's relatively sideways, and that brings in two important points that I'm going to talk about today. And it's just using this to your advantage. So essentially, if you had taken a trade that had gone wrong, okay, and let's say you shorted here fairly early on, but you did it lightly, which is okay, you would have taken gains here, but then you find the price rises with a big sharp candle from 37.50 to 39.50, 200 points, and your light short may have still been in there, or even if you placed it up here, it might still be there. Of course, you could exit when it comes back. But if you were trying to mitigate any previous loss from a incorrectly placed trade or a temporarily incorrectly placed trade, you've then got a month of sideways action to rectify that with hedge gains. Okay, and that's how to stay solvent whenever you're trading. It needs to, you can accumulate gains on the opposite side to which you're looking for the market to move. And this is a clear example of it, because you're going sideways, you're not really going anywhere, and you've got 20 or so days to deal with this, or 20 or more days. Okay, and you can see that because that is how many days usually are in a trading day. It's 21, 22, or 20 most of the time. Obviously, that's because you have several weekends. But at this point, you had a decision really where you could start to look to perform that. And if I just draw some arrows underneath these areas that I'm referring to, you've got one here, okay? And bear in mind, we did call this, okay? I do frequent E-mini futures analysis in the SPX. But each of these represent an area which is a light long. Now, the reason why it's a light long is because you haven't fallen terribly far away. You're still nearby, okay? The further away a trade falls, often is going to constitute a regular size. And by regular size, I mean one that you're happy to place at any time in the market, as long as there's good value on that trade. In other words, the price is more feasible than it would be if you were buying something that was high already. So that's why you would take it lightly. Now, you would take light gains 3 times in this scenario, because you would be looking to lightly short again, which I've already called in various videos. You'd be looking to do that further up here, okay? And it's the same thing again. And then, of course, if this blows through, you've taken those hedge gains, and you could even close for a net gain overall, but you could repeat the same thing when you get another period of sideways movement, because you get a lot of these times, okay? And they become very reactive for local price action and sideways movement, okay? So something like that, again, you get this a lot. You can make use of these because it's easy to accumulate gains or even just hedge gains. But yeah, so, we look to follow this as it happens. We know up top here is a early short, and here's an early long, because this is very close together. Okay, the distance between this essentially is going to be 4,100 to 3,900, okay, 200 points or so. So anything to the bottom is going to give you a light long zone, because you've already seen price react there. You know it's a long, okay, you can see that previously. And then up to the top side, it's the same. You've seen price react at this level before, and even historically over here where we, got our basis for the short to start with. Now, when it first bounced away here, I did say it's probably, it's likely we're going to pop higher, because we haven't fully dealt with those levels. So we're looking for reactive areas to take trades again, but we need to adjust our size accordingly. Okay, and often the more these levels get hit, eventually you're going to get that breakthrough. But we're not waiting for a breakthrough of a certain price level. We're just looking to trade it at that time because we know it's reactive. We've seen price come away before, and therefore we can summarize, or surmise our view in the right way, which would be in the same way it was previously. Because if something's hit a level before, it's usually a short, or if it's hit a long zone before, it's likely to be a long again. But you just need to drop or adjust that size because there's only so many times that can occur in one sitting of price action. So I hope that helps, guys. Roll it back, watch it a couple of times if you need to. As always, any questions, just drop them in the comments box and I can get to them. But mainly what we're looking at here is light long and light short zones. Anything higher up, just before anyone asks me, because they probably will, anything higher up, really, if you're more risk averse, you can just hold off here. You don't need to take those light shorts, or you can hold down to this 3850 level for a re-hit. So that's for guys who are more risk averse. Thanks for watching, guys. Hope that really helps, and I'll see you in the next one.